Welcome, and kindly feel free as we go through another good discussion together. And maybe you're just new to my channel and probably you haven't subscribed. I would kindly like you to do so, and if possible you can even make a share to our videos to other parties who may have some interest in our areas of study. Remember that I do upload videos every day, so they're going to be benefit from the channel. Now, our topic of discussion today is all about methods of charging depreciation. And if you talk about depreciation, we are simply referring to the loss of value of an asset. And an asset could lose its value maybe due to depletion, things to do with economic factors, and above all, we have an element known as time value of money. That is, the value of an asset today will not be the same as the value tomorrow if we factor in the element to do with salvage value. So here we have several methods that I'm going to show you. And the first one, we're talking about reducing balance method. I'm going to start with the two major methods of depreciation. Now, if you talk about reducing balance method, in this particular case, depreciation is charged at a fixed percentage over the remaining period of the asset. At a fixed percentage over the remaining period of the asset. And we are going to see an example to actually help us understand what we mean by that. And the question states, a tractor, in this case is the asset, bought at 2 million is depreciable at a cost of 25%. Show the depreciation that will be charged 3 years from now. So we talk about we are charging depreciation at a fixed percentage over the remaining period. Now we are supposed to talk about, remember the first year, there is a depreciation of the first year, which will essentially be 20 million times 25%. We get a value of, so 20 times 0.25, we get a value of 5. So the value charged as depreciation for the first year is 5 million. If we go to second year, the depreciation is going to be the amount which is 20 million minus what has already been lost, which is 5 million. It means the net book value remaining at year 2 is 15. We charge it at the same percentage, which is 25%. So if you have 15 times 25%, we have a value of 3.75. But we're supposed to talk about it 3 years, okay? So if we go to the third year, we are going to charge a value of 20 million, okay, minus the two values which have already been lost in the first 2 years. So minus 5 plus 3.75. We charge it at the same rate of 25%. If we minus this one, we're supposed to have plus 5. So 20 minus the answer is supposed to be 11. So we charge 11.25 times 0.25. We get a value of, so the answer times 0.25, we get a value of 2 point, not really 2 point, but it should be 11.25 times 0.25 we get a value with the same value 2.8125. This is what is going to be lost on the third year. Remember, but suppose we are supposed to get the total amount of depreciation that is going to be lost chargeable, we simply add these three, which is going to be plus 8.75. So total loss is going to be 11.5625 million. And that is all about reducing balance method. And then you go to the second method, which is known as the straight line method. We say that under this method, an asset is depreciated uniformly over its useful life, taking into consideration the salvage value. Now, if you talk about salvage value, we are talking about the value that remains in the asset at the end of its useful life. And useful life refers to the duration an asset is supposed to take. It is also known as scrap value. Now, because we are considering the salvage value, it means it's supposed to be subtracted when getting depreciation, because it is a value which has not been lost. So we're going to have, for example, ABC Limited bought an equipment worth 150 million. That is expected to last for 8 years and will be disposed of at 30 million. So in this case, our salvage value is 30 million. The cost of the machine is 150 million. But again, now we have the useful life is 8 years. Now, for us to get the depreciation, we are supposed to minus salvage value from the cost divided by useful life of this particular asset, which is the same as 150, which is the cost, divided by 30, minus 30 divided by 8. So we're going to have 120 divided by 8, which is supposed to be, so 120 divided by 8 is supposed to be 15. 15 million is charged as depreciation per annum on this particular. And then the third method is the machine hour method, whereby an asset is depreciated based on number of hours operated in a given accounting period. That is, it means that this number of hours that the machine runs is what leads to its loss of value. And we have an example here. A machine bought at 12 million is expected to run for 20,000 hours during its useful life, and will have a salvage value of 20,000. During the first year of operation, it ran for 5,000 hours. Now, in this particular example, it means that for us to get depreciation, we are supposed to divide the number of hours run, the number of hours that this particular machine ran, divide by the total hours that was expected hours, multiply everything by what is known as depreciable amount. That is the amount that should be subjected to depreciation. Now, in this equation, it means that we have the number of hours run, which is 5,000. What was expected is 20,000 from the equation. So what we don't have is the amount which is supposed to be subjected to depreciation, which you're supposed to calculate, which is depreciable amount, is supposed to be the cost of this asset, which is 12 million, minus what remains at the end. 20,000 is supposed to be 0.02 million. We get a value of 11.98. That is the depreciable amount. Now, if we subject all this to the formula, it means that we are going to have depreciation as 5,000 divided by 20,000, what was expected, times 11.98. So we'll divide 5,000 divided by 20,000. We'll divide by 5,000 divided by 20,000. We get 0.25 times 11.98. We get 2.99. So we get a value of 2.995 million. That is the value of depreciation. And then we go to the fourth step, the fourth method of depreciation, charging depreciation, which is the sum of all digits method. Now this is a special type of method whereby we take the sum of years an asset is expected to last and comparing the number of years expected in an accounting period. And you can illustrate that in our example here. A mower costing 25,000 is expected to last for 4 years with no salvage value. The year, we are going to have years versus what is remaining. Of course, we are given 4 years is supposed to be the first year, second year, third year, and fourth year. So it means that at year 1, this asset is supposed to run for that 1 year plus the other 3 years. So it is 4 years. At year 2, it will run for another 3 years. At year 3, we are remaining with 3 years, the third year itself and the fourth. And then at year 4, it's supposed to run for, this is 2 years, sorry. At year 4, it's supposed to run for that fourth year alone. So it means that when we add all these one, the remaining years are supposed to run for this particular asset, we get a value of, this is 8 plus 7, which is, 7 plus 3, which is 10. So we have 10 years remaining in the total for this particular asset. Now, for us to get what is supposed to be charged in the first year, is supposed to be, so first is supposed to be 4 over 10 times 25,000, because there is no salvage value, so we simply use that particular value and we get an amount of 10,000. That is 10,000. Then we go to year 2, which is supposed to have 3 over 10 times 25, which gives us 7,500. Then at year 3, what remains is 2 over 10 times 25 again. We get a value of 5,000. The last year is the 1 year remaining over 10 times 25 5,000, you get a value of 2,500. Now, for us to get the total depreciation, we can simply add this one, and the value is supposed to be 25,000, which is actually true because we are told there is no salvage value there. It means the whole cost has been lost, this particular asset. Then of course we go to the fifth method, which is depletion unit method. Another depletion unit method, we are talking about a case whereby depreciation is charged for every unit produced. It means every production has some loss of value attached. And we have an example here. A quarry bought at 20 million is expected to produce 0.1 million tons of minerals. During the first year, a total of 5,000 tons was produced or was extracted. And we say that we charge depreciation for every unit produced. So we are going to charge depreciation for every ton that was extracted. Actually, this is what is being produced. So essentially it means that for us to get depreciation, it is supposed to be the cost of the asset divided by the expected content, which is supposed to be produced, multiply by the number of units taken or produced. And in this case, we are going to use the word 5,000 tons were extracted. So it's supposed to be the cost of the item, which is 20 million divided by 0.1, what was expected, times what was actually extracted, which is 5,000 tons. 5,000 tons, which is supposed to be actually, is supposed to use 0.005 million because we are working in terms of millions. So when you divide 20 divided by 0.1 times 0.005, we get 1. So we are supposed to have 1 value of depreciation, this particular example. Then the sixth one is units of output method. Now under this particular example, depreciation is charged in terms of expected output of an asset during its lifetime compared to the output in a particular accounting period. So we are comparing what's supposed to be expected from this particular asset with other particular accounting period. And it means that for us to get depreciation using this method, we are supposed to divide the number of units in an accounting period. You divide everything by the total number of units expected. The total number of units expected. You multiply everything by depreciable amount, the amount which is being subjected to depreciation. Depreciable amount. So you can have this example here. A machine is expected to produce 200,000 toys during the period of ended 31st December. A total of 20,000 were produced. Okay, the machine cost 5 million and was expected to have a salvage value of 2 million. Now we are going to use this one to get the depreciable amount. So in this particular example, we are supposed to get what was expected versus what was produced. So you are given that during the period ended 31st December, a total of 20,000 were produced. So this is the accounting period. You are supposed to divide that 20,000, which is the accounting period, divide by 200,000, what was expected, times the depreciable amount. In this case, depreciable amount will be the cost, which is 35 million minus salvage value, what remains at the end, which is 2 million. And in this case, we are going to have 20,000 divided by 200,000. We get 0.1 times 33. We get a value of 3.3 million. That is the depreciation that was charged. And then finally we go to the last method. I know it has been a long journey, and we're talking about what is known as revaluation method. Now under revaluation method, depreciation is charged by grouping assets to have a single figure that is then revalued at the end of an accounting period. So it means we can have assets be grouped together, and an accounting period normally have what is known as opening balance and closing balance. Like in this case, an assembly company has a total of equipment whose value is 200 million as valued at the beginning of February 2019. Okay, additional equipment are bought at 20 million. So they have this one at the start, then later they buy 20 million. Then you're told that on 29th February, that is the end of that particular month, assets value is at 190 million. So we are supposed to get the depreciation. So essentially, as I said before, we are supposed to talk about the elements of the opening balances. We talk about the valuation at the beginning. So the valuation at the beginning, which is essentially an amount of 200 million. Then we're supposed to add purchases during the year. So what was purchased during the year is essentially 20 million. When you add those two, we get what is known as part of the 220 million, which is part of the assets which are essentially assets available for operation, to facilitate operation. But at the end of that month, we had 190, so we are supposed to less the closing valuation at the end, which was 190. When we less this one, we get a value of 30 million. And this one was the amount of depreciation that was charged for the year. Thank you very much, and please don't forget to subscribe.